Welcome to Capital Conversations, where innovation meets opportunity. Join hosts Karen Rands and Erik Nelson as they unpack the realities of raising capital, from angel investing to IPOs, and reveal what it takes for companies and investors to thrive in today's changing markets. Let's get started.
Hey, good morning. I'm Erik Nelson, and I have my co-host Karen Rands with me. And today we are going to be talking about Regulation A offerings. And we're diving into the world of Reg A offerings, and we're going to take a look at the capital raising capabilities and how this is a useful and I think an extremely important tool for raising capital and growing and funding your business going forward. So you're not going to want to miss a second of what we've got coming up. And here we go. How are you today, Karen?
I'm doing great. And you know what? I'd like to add for people that are just tuning in or starting to listen, this is important for you if you are an established company, whether you raised capital early on or not from angels or friends and family, and you have reached a point where you like, you know what, I have a whole other product I want to bring out. I want to expand. I want to acquire another company. And you struggle to figure out where to get the capital to do that. The banks can't give you enough money for what you need. VCs are not, that really is not something, you're not a VC type company either because of wrong industry, location, you're not with a hub of a lot of VCs, or you're just not in the growth trajectory of what VCs look for. You're too big for angels and you're too small for private equity funds. So where do you go? That's what you're going to get answered today. We believe that Reg A Plus is a terrific solution for those kind of companies, and we'll talk about other scenarios where you can use it. But I wanted to put that in there, Erik, because I think it's really important. And for those investors, because you're going to hear this term, the great economic democratization of the capital markets, right? There's a big fancy, lots of words, lots of syllables. But you're going to learn that because it is also a terrific place for investors to look at for an asset where they can get in, where it's less risky than a startup, but still has tremendous upside potential compared to a regular IPO offering or a company that is already public that is doing that is just you're buying stock from somebody else or might be doing a secondary offering. So with that, I just want to put that out there so people will listen. And then we have our disclaimer. So you're going to read the disclaimer today, Erik?
I'm going to do the disclaimer today, so everybody bear with me. This is my first attempt at it, but the information provided in this podcast is for educational and informational purposes only and is not intended as financial advice. The views and opinions expressed by the host and guests are their own and not necessarily reflect the official policy or position of any financial institution or organization. You should always consult a qualified financial advisor before and conduct your own research before making any investment decisions. The content of this podcast may include forward-looking statements that are subject to risk and uncertainties. We do not guarantee the accuracy, completeness, or usefulness of the information discussed. And by listening to this podcast, you agree not to hold the host, the guests, or any affiliated parties liable for any losses or damages that may arise from your reliance on the information provided. Meaning, don't blame us if something doesn't work out. I would like to say, you were talking about banks not providing capital. One of the things that most investors do not realize is banks don't make risk capital investments. They don't do equity. They loan against secured assets and secured assets only for most small businesses, which really means they're just not available sources.
Yeah, because they have, specific buckets that companies have to be able to provide assets, cash flow, some kind of guarantee. They have to have a recourse to them where, they can provide a lot of money, but they can't provide over what the company has, available from a value standpoint to qualify. It's not looking at future potential, which is what equity does. It's just, this whole series has been about the idea of companies being able to sell the equity of their company because of a promise or a suggestion of future opportunity of what that equity is going to be worth. every type of equity capital is based on this future expectation of worth.
That's right. And so and that's why they've got Reg A offerings, for example. Why don't you give us a brief, explanation of a Reg A offering, what it is, and how it differs from traditional capital raises?
Okay, sure. So I think it's important for folks to sort of step back just a little bit to understand, because a lot of times I found, since I wrote my book, Inside Secrets to Angel Investing, pointing to my flyer behind my head for those that are watching, it has become harsh reality, like an unexpected reality. I kind of knew it when I ran the Angel Group, but there's a whole lot of people out there that don't either, if they know that there's an opportunity to purchase equity of a company, they don't have a positive idea about it, right? The other, it's just stocks and real estate, public stocks and real estate, pretty much as the asset classes that they know. And that is because it was really a very limited pathway to be able to raise capital through selling of equity. And it's fairly new. I mean, new relatively speaking, in that when you think about all the security laws that were put in place that drive all of the regulations that that Eric and I have been talking about for the last several weeks, that was started with after the collapse of the stock market, which triggered the Great Depression. And then they had security laws that were put in place in 1933 and 1934 that established what companies had to how they had to submit their financials, what they could disclose or not disclose, what they could talk about in public. It created a private environment for the buying and selling of stocks and the raising of capital. And then in 1984, the Reg D provisions came out that allowed for companies to be able to solicit capital from a select group of investors. Typically, it was people they already knew, or those that were represented by a broker dealer or through a broker dealer. They would use a broker dealer to get access, which we've talked about as well. Angel investor groups, which became a rise, really right around the late 1980s into the 1990s. And then Reg D became a real big way for companies to raise capital after the .com bomb. Okay, but it was where you had very select companies could not general solicit. That was the real dividing factor of a private offering or a public offering, of standing up in front of a pitch event and saying, hey, I'm raising capital, was illegal. My Angel Group, even back then, we would close the door of a room just in case somebody walked by, a wait staff, a random Joe, and wouldn't hear somebody saying they were raising capital. That's how serious we took it. Okay, so when you see these big private equity conferences and people are standing up there, saying they're raising capital and how much and what the terms are, they're kind of they're in a really no man's land of violating provisions of this, because they need to have filed one of the exemptions under the Jobs Act to do general solicitation. Okay, that's 2012, and we've talked about that. So Reg A was part of those original rules, and what you had to do was companies, and through a broker dealer primarily, I think 100% of it was because of just the complexity of it. You had to file in every state if you were going to solicit capital in that state. There was a ceiling of $5 million. It was cumbersome. It was called blue sky filings. You had to file in that state. You could test the waters, meaning that you could go out and your broker dealer would send out to their clients. They would say, are you, hey, we're going to be doing this offering. Are you interested? And if people said they were interested, then they would file in that state, because it was costly to file with every Secretary of State and in the states. And so it would be limited on that, right? So that was the way where it first got started as a Reg A. So when they came out with the Jobs Act, which comes to this economic democratization of the capital markets, and we'll explain the motivations behind that, because I'm sure there's a question in that. The very first one that was created as an exemption for the general solicitation rules was Reg A plus, or Reg A. They basically took Reg A and split it into two types of offerings. The first one is, as it has always been, 5 million, file in the States. Do not need audited financials on that. I'm sure we're going to get into what that means. The second is what we call Reg A plus. Okay, so it's a tier 2, the second tier of Reg A. And it started out at about, I think it was 20 million. I went to try to look it up, but now it's been so long you have to dig down into the bowels of Google on that. But it got increased, and it initially, there's been some changes. I'm sure Erik has looked this up because I've challenged him with that way. But for companies that were already trading, whether they could or whether you could actually go and finish the filing and become a public company, that's been back and forth because when you got something new, a lot of times people push the limits and they try to see how far they can go. And so you had companies that were brand new startups who were raising capital this way, which it's not ideal for, and that had to change. And so they've tweaked it over since 2012. And today you can raise up to $75 million in a year. You don't have to do it all at one time. Sometimes people do it in multiple tranches, and from accredited and unaccredited. And existing shareholders can sell at that price on secondary markets. So it really has become an incredible vehicle for companies to raise capital that don't fit into the narrow pipeline of of angels to VCs, or somehow, for whatever reason, don't want the idea of a private equity fund doing a leveraged buyout with them. They want to continue to grow their company, or they want to do an offering for their employees and their existing shareholders to get access to liquidity better than an ESOP or anything else. So, that answer your question?
That more than answered the question. You touched on, and this is important. There's a lot of changes coming down, and I want to emphasize to everyone who's listening, what we're talking about here, and in subsequent podcasts that we're going to do that cover Reg A offerings, I think this is going to be one of the most important tools for small companies to raise capital so they can grow and to become larger companies and create wealth for their investors and their shareholders along the way, and employees. As Karen mentioned, Regulation A offerings are broken down into Tier 1 and Tier 2. Tier 1 is able to raise up to $20 million, where Tier 2 is able to raise up to $75 million. And one of the key differences between a Tier 1 and a Tier 2 offering is Tier 1 does not require audited financial statements. You can work with unaudited financial statements, but if you're going to do a Tier 2 offering, you have to have audited financial statements, just like you were going to submit them to any other filing with the SEC. But it does come with certain marketing advantages. So you can market a Tier 2 offering a lot easier than you can market a Tier 1 offering. And if Karen could explain some of those differences, which she knows far better than me, I think it'd be really helpful for our viewers.
So you're referring to the whole idea of general solicitation?
Correct.
Okay.
Correct.
So, so there's a couple of things you need to think about when you are considering this. First of all, Reg A or Reg 1, the Type 1 for Regulation A, is really done through a broker-dealer to their known clients. This comes back to that. I said that idea of general solicitation. So let's break that down. Solicitation is selling your equity. I'm soliciting for people to buy my equity. Do I do it privately on a I know these people basis, or do I do it generally to the general public? Hence crowd, right? Crowdfunding, yep. Right? So it's a general solicitation to the public. Unlike of the other ones. So Reg CF, a biggest difference is that you have a limit. We'll go into more detail on that, but you have a limit on how much. It can be accredited and unaccredited. Reg D is broken into two categories. I mentioned Reg D before, and Reg D 506B, this is how they separated out that provision that had been around for a number of years. That is just the way people do it, have been doing it all along, right? They've got a PPM, and the angel investors typically are the ones that invest in that. They sign in an investor questionnaire. Reg D 506C is unlimited in how much you can raise, but you must prove that the investors are accredited investors. That means they have a certain level of net worth, $1 million in net worth, not including their household, and household income of individually, I believe it's 250,000. Combined income is 350,000 in a household, and we'll cover that and all of that kind of stuff. But that's important to know, because that Reg D 506C has become popular, but because as a general solicitation, but you have to really limit your exposure, because there's additional risk associated with it, additional costs associated, whereas Reg A plus, anybody. Okay, so I liken this, if I think about my dad, God rest his soul, he used to be one of those guys that loved pink sheets, right? He would love to do the penny stocks, because his idea was, oh, if I can buy it for a quarter and it goes up to 50 cents, then I've made double my money. Right. It was a very simple process that he would think in his mind. It had an upside potential. The Reg A, with Reg A plus, it's a similar model, but it's ideal for companies that have, because they have the audited financials, and Wall Street actually likes it, your investment bankers and some of your fund managers, because they can look at the historical history of that company that is truthful, transparent, and adheres to all of your guidelines of GAAP and the finance rules, and it's by people that are licensed or anointed, if you will. Erik's got all the official language there of by the SEC that they are okay to do this, and so they like to look at that, because then when you look at those forward-looking statements that I talked about, you can have a better sense of, do they have the bones, if you will, to be able to grow? How are they going to use this money, and do they have the foundation to build upon to achieve the outcome that they say they forecast? Never a guarantee, but they forecast that they're going to get to. And so it is it's ideal for companies that are really looking for that growth capital, and to either get acquired or to finish going public, which we'll be talking about.
It's also a great interim step to raise money if you want to uplist to an exchange. And I think that's going to be a key thing coming up. So as you talked about, there's several benefits for the companies to do this. Broad access to investors, a little bit lower entry point to compared to an IPO, a little easier to come across. And then it's, creates potential liquidity for the investors. One of the things I found out that some of the clients I've worked with have used a Reg A Tier 1 to raise some capital in preparation of a larger capital raise with a Tier 2, which requires the increased disclosure. And that's something for a lot of company executives to keep in mind.
Let me add something to that, though, Erik, because I think in a lot of ways a Reg CF, or even interstate exemption, which is one of the other ones that I didn't talk about, that's allowed through the Jobs Act, or kind of as a result of the Jobs Act, because you can raise up to $5 million. It is a really good, it's a less costly mechanism for a Reg A plus. It's a similar mechanism in that you have to have when you're thinking about, is this right for me? Besides the legal aspect of it and the audited financials, because now there are some auditing requirements under Reg CF, depending on how much you're raising. But it doesn't have to be like the official type of audited financials. But it is a great way to see if you have to stretch your limits and see if a company has the mechanism, because of a thing that I think a lot of companies underestimate when it comes to whether Reg CF or Reg A plus is the amount. They know they got legal costs, they know they got accounting costs, but they don't really anticipate the marketing costs. It is, you have to budget for a marketing cost on this to be successful. It's a win-win if you are a company that is driving any B2C type of business, or if you're trying to create brand awareness, say you're launching a national franchise, you're trying to get national exposure, you do want to get on the radar of a company that might be acquiring, because when you do the marketing side of this correctly, you are creating massive awareness of your company that didn't exist before. And that can generate additional revenue. It can generate additional offers for joint venture, for acquisition, for just all kinds of things that companies may not mount that level of a marketing campaign if they were just doing it for revenue purposes. So and if you do it right along the way and you plan it out, it takes many, many, many months. Okay, you plan it out, then your value goes up. I did a podcast not too long ago with a company that was doing this for a role. He was going to be acquiring companies. And he took back his Reg A. He stopped after raising $12 million because his value of the company had gone up so much in the marketing that he had done on that the value that he was raising it at that point, he didn't want to raise another 10 million at that value. So he stopped, use that money, continue to grow, and then he came back and did a second Reg A.
Yeah, and that happens a lot. The success of that offering, the influx of capital causes the value of the business to jump quite dramatically. And that's sometimes why you'll see companies do a series of different transactions, walking the price up with each successive transaction. And that can be very good for the early investors that get into it, particularly when the liquidity event comes.
Right. And then, do you know, Eric, I just was thinking about this, because you have the testing of waters provision within both Reg A's. And there's, usually some old statistics I saw that was like 40-something% of the companies that do a Reg A plus do a test the waters as part of that. And that's a way, testing the waters is, like I mentioned earlier, is a way to gauge the interest in your offering. Can you test the waters under Reg A plus while you're raising capital under Reg CF?
I don't believe so, because I'd have to consult with one of our securities attorneys, but as a general rule, the SEC does not allow you to conduct two separate offerings simultaneously.
Yeah.
So, for example, you cannot conduct a Reg D at a fixed price while you're doing a Reg CF at a slightly different price.
Oh, no, I do know you can do Reg D 506B at the same time as a Reg CF, but you're right, it is the same price.
Yeah,
it's just that the Reg CF becomes a special purpose vehicle that's in this small amount, and it gets structured in one way where a Reg D 506C has a bigger threshold of minimum investment and things like that, so they get different rights as a result of that.
Yeah, but it's effectively the same pricing. But that is a very rare circumstance that just most companies won't come across on this. We've covered a lot of the topics here. How do you see Reg A plus evolving over the next 5 to 10 years?
I think you're going to have, I like that question. Thank you for that question, because you and I differ a little bit about this, because fundamentally, I'm not a real big fan of reverse mergers, which I think we'll be getting into more later this month, or next month specifically. But I think, and I think that Reg A plus, the reasons why a lot of companies would do a reverse merger in the past, there's strategic reasons why that Eric has talked about on prior calls. It made me become more open to reverse mergers than I had been, for their very specific reasons that they do that. But I've seen so many companies just get decimated by doing a reverse merger, because they're having to chase the tail afterwards and create a market for their offering as they're already public. Where with this, you're building the momentum for a nice public offering that holds its value. A couple weeks ago, we talked about the collapse of value after a company goes public because they have an inflated valuation, where with a Reg A plus, you are building that value story while you're raising capital on what it is that you're going to do with that. So I see it as a way, and awareness has been really low. Even though billions of dollars have been put into Reg A pluses, you don't have a lot of news about these companies raising capital about it. They kind of do in hindsight. If a company goes belly up, like Elio Motors, or with the struggles that they have, right? You'll hear, oh, well,
Yeah.
they raised 17 million under a Reg A plus, those, whatever. But there's a lot of success stories out there. Like, for example, Brewdog. Is it Brewdog?
Yeah, Brewdog.
Brewdog. They early on, they wanted to test it out in the US. They had raised capital under a crowdfunding provision in England, and they came to the US, and the way they saw it as a way to basically replace their marketing budget, because they're raising capital and creating brand awareness, like I talked about before. So their first raise was, they wanted to raise 20 something million, but I think they only raised about, I didn't look it up, but I think it was about 10 to 12 million that they raised, but they built a brewery with that. The next raise that they did, they launched microbrews and retail locations around the country. And then they did a third Reg A and it continued to expand. And the thing that they offer as part of a benefit, because one of the things about, if you know crowdfunding, and some people know reward-based crowdfunding. So reward based is you just get a reward, right? You just get something in exchange. You don't get equity. Whereas equity based crowdfunding, they still do tiers where you're getting equity, but sometimes there's additional perks. So one of the perks under Brewdog was that their people that own the shares, besides getting revenue sharing in that, is that they get through just a normal way that you would disperse revenue or proceeds or profit, but they get I think they get to go to the brewery or go to a location and get a free beer or some limit to the number of beer. And so they find that
It's
a
a
lot of the
discount. Yeah.
they find that a lot of people go, and this is where they're amplify their media, their marketing, is that they'll go and they'll say, hey, here I am, and they take a picture of themselves, drinking. I'm an owner. I'm a share owner in this company, and they advertise it on all their social media. So they get a lot of free advertising as a result of it. So it is, so I think you're going to see a lot of companies use it as a way to get access to growth, particularly as we see VCs start to tighten up because of this economic turmoil that we have. And you're going to see people needing to raise capital, and because they can have a direct to investor conversation about the value proposition of what they bring to the table, people are looking for an alternative than the stock market with the volatility of it, where you have no control. You don't know why it goes down and go up. When you buy a private company, and this is my soapbox, when you buy stock in a private company that's using the money to grow their business, odds are, unless they just royally mess up or raise too much capital and they don't know what they're going to do with it, or you don't know how to evaluate a company, and my number one rule, don't do it on emotion, look at their financial statements, is that you have a much better odds of upside potential on that. So the first thing is, I think it's going to take a replace of reverse mergers to a certain degree, and it's going to, because you have another option, and it's going to attract that retail investor that would be looking for that company that has the best upside potential, that just did not ever know that they could buy private stock before. Now they will know that they can do that, and it's going to fill the gap from VCs that are not necessarily reinvesting in existing companies or investing in new companies that are in that trajectory where they might have $5 million and need to raise another $15-20 million to get to their next life cycles.
One of the things I'd like to point out, and we'll get into this in a later episode when we talk about reverse mergers, but a Reg A could also go a long way towards making a reverse merger an appealing idea and increase the chances of its success. And this is where we start to tie everything together. But I also want to point out, and there's a company that I know you're well aware of. It was in the brewery space. They made beer here in Atlanta, and they struggled to raise money for a long time. I think they presented at one of your events.
And we came very, very close to getting a good amount of money into that company, except for their CFO would not do forward-looking statements and tell us what he would use that money for, because he was an public company, and he was adhering to the public company stuff of not making forward-looking statements, which is,
He also had a flawed financial model, which we could talk about down the road.
yeah.
Because I looked at it, and I'd previously worked on beverage company projects, and you've got to actually have key, deliverables and metrics in your model that, like how many cases of beer am I going to sell, those sort of things. But I read here a few weeks ago that company had ultimately gone out of business because they never succeeded in raising capital.
I know. It's
And
very
and the
tragic.
one thing that they failed to look at through all those years and all those discussions, as they never looked at how our Reg A would benefit them on the favorable terms. And the other thing is, venture capitalists run hot and cold on industries. SPACs were out of favor until it wasn't GameStop, but it was FanDuel or something. One of those companies went public in a SPAC, and then its stock took off, and everybody wanted to do a SPAC, and then you had all these amateurs get involved that did bad SPACs, and then the politicians started to criticize them. But the Reg A should be considered by anybody looking to raise capital and anybody who wants to grow their business to the next level. I'm off to Planet Microcap next week, and the investment bankers, they have a minimum threshold for what they can raise money for. And if your company's down here, and we'll get into this more, but if your company's down here, you're kind of shut out. But if you can take a Reg A and get your company up here, then you're the darling of the dance.
Right.
You're the one that they want to talk to. And it's their job is to find companies they can raise money for. These guys don't get paid unless they can raise money. So they're always looking for that. And this is why this is going to be a super important topic, particularly as we explain what is happening in the other areas as to why this becomes what gets you to those other levels. I think we've covered a little bit how Reg A differs from the Reg D and the Reg CF. Anything else you'd like to talk about on those, or mention how it differs from a full-on offering document in the form of an S1 registration statement?
Well, we can go to the S1 thing in just a second. I just, bringing back bringing home the idea that Reg D offerings that most people think about in the investment space, from angels and just in general, excludes 90% of the population from participating. Okay, so just keep that in mind, right? So because of the income, the accredited investor status, and the private, we broached the private side of that and the public side of that for general solicitation. But keep that in mind. So depending on your type of business and what you are, when I advise companies on raising capital and what is the right type of way to raise capital, one of the things I look at is who is your ideal investor. Your ideal, just like you do with customers, who's your ideal investor? Okay, who's going to understand what you're doing the most? If it's a very complex, it's a complex business model or a complex type of what you're doing, enterprise software, for example, right? Or something that's like a huge amount of cost of goods, or cost of, like, it's a manufacturing kind of big iron sort of thing. You're, going to do, big equipment stuff, right?
Yep.
Then you're not, Reg A is really not going to be for you. Any of the ones that target individual consumers, you're going to want to be like through a Reg D and a Reg D 50 we'll talk about this more, but a Reg D 506C, getting access to family office, super high net worth families and institutions and trust funds and things that invest in not startups, right? They don't invest in
Yep.
startups, but they have patient money. That is not, those kinds of things. You have to think about who is the ideal potential investor slash customer for your equity, because that will dictate it. And then how much are you trying to raise, and what is the goal on the outcome? Is this a baby step that you're going to do many, many more rounds? Then, you might think of Reg CF to fund future rounds of something. If you're already at a point and you've got good fundamentals and it's just amount to raise, remember it's up to $75 million, before you finish your S1 filing, then, Reg A plus. So this is all part of it. And the last thing I want to put in there as part of this is that, again, the prep work. You've got to prepare. You have to have a system for identifying, attracting, and creating a funnel of investors, that you own the relationship with those potential investors so that you can move them through the process until they become somebody that is now a customer of your equity. It's really important to have a strategy and a mechanism and the infrastructure to be able to do that, either internally or outsource it to somebody like us. But that's what you're going to want to make sure that you have, so you can do this. You just don't, it isn't build it and they will come. No crowdfunding strategy works just by putting something up on a website or putting something up on a portal or putting something up on there. None of them, you will not raise the amount of money you're looking for if you do not have a marketing and advertising strategy and a way to capture those leads and close those leads.
Oh yeah, outreach is super, super key. It's it's like if a tree falls in a forest, no one's gonna hear it if you don't have the outreach. I would also like to point out there's another thing that one of my securities attorneys buddies here talks about in town, is that a lot of entrepreneurs come from middle class and lower income families. They're hardworking, go-getters, and when they're looking to grow their business, when it comes to the friends and family around, they look around and go, I have no family. I have no family that meets the definition of accredited investor. I have no one I can go to raise money from. Or they're nervous. They're like, I don't want to raise money from friends because if it doesn't work out, I'm not going to have any friends, or that. I mean, there is that old adage, but they're like, I don't know any accredited investors, and that's a lot of people. I mean, there's just like, who do I know 5 people, that's it. And so that's where the general solicitation portion of Reg A is something that is unrecognized and creates huge potential for these guys to build their businesses.
Yeah.
And we're going to get into that more in other episodes.
Yeah. And then, and I think it's important I talk about the marketing, but let's just run through some pricing expectations of, and we're going to get into this on the hot topics, which I guess is next week. But like Newsmax is one of those successes. I just saw that article, right? So they raised 7.5 million shares of Class B common at $10 per share. And I think they were supposed to be ringing the bell yesterday.
They did. My wife, we saw the private placement memorandum at my house, and we passed, and my wife gave me a tremendous amount of grief this morning. Tremendous, because it opened up for trading 753% above the offering price. So
753%. 753%. Hello, investors out there.
I mean, that is, as I look up the Newsmax ticker symbol, it's just to let you know, on the very first day of trading, and the ticker symbol is NMAX, NMAX. Newsmax is right now trading, She asked me if I wanted to buy it before I left the house this morning, and I said no.
And how much more has it
Um,
gone up?
well, okay, so Newsmax was around $80 when I left the house at 9:30 this morning. Newsmax, as we speak, is at $145.
Wow. So there you go. See, that's the thing, right? It's like it is, and people already knew Newsmax, so they had name recognition. And if
It's
you were a regular subscriber or reader of them or whatever, you probably knew about the offering, right?
it traded as high as $193 a share this morning, up
Yeah.
from $10.
And Wall Street is looking for good deals that have good stories, that have good potential. So as much volatility as there is in the market, when you have a story of this to this, okay, goes from here to here, people like that. And guess what? Everybody could play in that deal as a Reg A plus. Everybody could have bought those shares at $10 a share, which, okay, so part of the reason for the Jobs Act and this great democratization of the capital markets, everybody talks about the way for entrepreneurs to be able to raise capital in ways that they couldn't raise capital before, right? They had a limit on their because of what I said about general solicitation and Reg D and limited who you could go to, had to be accredited millionaires, all that kind of stuff. And so they needed to open it up in the Great Recession as a way to allow companies to raise capital, particularly if they didn't fit into those narrow gauntlets of angels to VCs, weren't in a geography, didn't already know wealthy people, blah 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 blah. Okay, all of that stuff. So you can just general solicit to your customers, to the population, whatever. But it also was an opportunity because the other thing that was a realization out of the Great Recession of 2009 to 2011 was that a lot of people lost their shirts. They lost their entire retirement because of the collapse of the real estate market and the collapse of the stock market. Yes, we got it going up and down right now, but back then it took a decade for the baseline of the Dow and S&P to get back to where it was when it collapsed. And the same thing with real estate, particularly in hard-hit communities like Florida and some of the places where there are, rental properties and things like that. So whereas if people could get into an early stage company and buy their stock at $1 a share that went to 10 or $10 a share that went to 83, they could ride that wave. So they saw that so much technology that we take for granted now, smartwatches, 3D printers, drones, VR headsets, even, I always love to do this one, the fidget widget that was
Oh my
all the
God.
credit for all that. They all came to market with reward-based crowdfunding, meaning that, and I was talking to a lady just yesterday who's who's um who had worked on, I guess it was the early Oculus headset, and he was working as an intern, and he ended up making a whole bunch of money. Didn't realize he was getting paid in shares. But anyway, somebody that paid $1,000 for an early version of Oculus headset, right? When it was a young guy in a garage, and then $800 million by Zuckerberg to buy it, to put it into Meta. Would that
Yep.
$1,000 be worth 8,000 or 80,000? We don't really know because we don't have an example of that. But what we do know is that that obsolete headset that they got for $1,000 is not even worth the plastic it was made out of today. So that was where they said, why are we limiting people's ability to invest in these companies? We don't tell them they can't spend 20 grand in Vegas, and throw it on the slot machines. We don't tell them they can't go and buy a $500 lottery ticket every week. We don't put any limit. We don't tell them they can't buy crypto. We don't tell them they can't buy anything. It's an age thing, 18, right? But you can spend as much money. But we had all these restrictions on people investing in the companies, whether it's down the street or a company they know like Newsmax. We don't have that anymore. So it is the great democratization of the capital markets, living and breathing as we speak.
It most definitely is. It most definitely is. And
So
it's
get ready, right? So let's talk about some of the costs, and you might have some good numbers on this as well, but because you know a lot about like the S1 filings and all that stuff, and we can go into that if you want. But you it's going to cost. You should use testing the waters to validate, is your marketing strategy, is your offering price good, just all that stuff while you're going through your preparation of your legal work and your audited financials. So legal costs could be $120,000 or more. You should think about that as part of this. Audit costs, $30,000 or more. You might have a selling agent cost in there of like 7%. You're going to be looking at a marketing consumer cost of the amount of your raise to be about 5% of your cost of your raise, of how much you're raising. Broker dealers are not required, but could add, as much as 10% onto the cost of sales. What do you think about those numbers, Eric, and what would you like to add to it?
I think the legal cost. I think if you work with the right attorneys who've got the right experience, you can get that legal expense probably down to the $50,000 to $75,000 range. Your audit costs are getting up there. There's been a lot of, the PCAOB, Public Company Accounting Oversight Board, has forced a lot of small auditors out. But I would say the biggest thing that people need to really pay attention to and put the effort in is on the marketing side. You have to market these properly. And we'll talk about that in a lot greater detail coming up in the future. But you go out there, you raise your money, you cover your expenses, you move up the food chain, you move up the value ladder. And you go out there and you raise money, you build your business, you can come back a time or two and successfully raise more and more capital. And then eventually you either do a self-listing, which is what Newsmax did. They applied and got approval, or you do an IPO. But this is wealth creation. And ultimately, if you're going to run a public company, you're either going to do it because you've got an ego, or you want to create wealth, or possibly both. But as far as all this goes, I think that really, you're looking at 100,000 or more, 150 by the time you're all done to make this happen.
Yeah, for sure. All right, so we've got a few more minutes here. What did we not talk about that you wanted to ask me, or you want to throw your concept, your ideas into it?
Well, I would like to say, with respects to a full-on IPO type registration statement, those are called S1 registration statements. And an S1 is to a much stricter standard with a greater scrutiny by the SEC and a higher level of disclosure. But with an S1, despite the greater disclosure, you cannot do a general solicitation, to the best of my knowledge. So if you want to be able to solicit the public or do a crowdfunding, you have to do a Reg A, and preferably a Reg A plus. But here's the kicker. If your company is already publicly traded,
oh yes, that's
and
what
you're on the over-the-counter market, or you're a small NASDAQ company, you can do a Reg A plus to raise capital. And a lot of people are not thinking about this when they should be.
Yeah.
If you're out there and you're like, I have found myself the CEO of a small public company, we don't have the critical size to attract investor interest. What am I going to do? Call us, reach out to us. You can find us on our, you can submit an inquiry on our podcast page at sterlinginvestments.com/capital conversations. And you'll be able to, reach out to us. But the fact of the matter is, if you are a public company and you do have critical size, I have a client that does about $250 million a year in revenue and trades on the pink sheets. Think about this. They're a $250 million a year company. They trade on the over-the-counter market. Their stock is approximately $220 a share, and it's got a 50-cent spread between its bid and offer. That's a strong investor interest. I mean, they trade. Go ahead.
Well, I was going to say, why is that? Just because they haven't done certain filings that they would be on pink sheets?
I don't believe they ever got up to an exchange. And you got to go look at these the history of the market prior to the reforms of the 1930s with the Exchange Act and the Securities Act. Companies would trade over the counter, and there was no requirement for registration of the securities because there was no registration. So and if you've been around long enough, you come across these companies. They're older. They were formed prior to 1933 and 1934, or the reforms of the 70s. And so they've been out there and they've been publicly traded, and they've just never been on a stock exchange. And they've just stayed there for years. But when you've got a company that pays a dividend and the dividend yield is less than 3%, that's an indication of a strong investor following. And so you can be on the over-the-counter market, have a good business, want to grow, want to do acquisitions, get some expansion capital, move to the next level. And there are ways to do it. And this is what we're here to talk about. How you can do that, how you can grow your business, and how you can get to the next level. Now, this particular company is planning on eventually filing a registration statement in the next couple years and moving up to an exchange.
Yeah.
But, as to when, I don't know.
Yeah.
So, but these opportunities are out there.
Yeah, I think that is something I meant to say when you talk about the future of Reg A Plus. I do believe that you're going to see a lot, because there's starting to be success. There is still not really a really clear pathway for investors to go, where are the Reg A Plus companies? It's really up to the company to create that relationship. We haven't really seen that like you do with like crowdfunding platforms and stuff like that, because they do really want to have this, I guess, they're an easy. I'm not quite sure why they haven't, because Reg CF is a regulatory requirement for companies doing it under a Reg CF. There's different kinds of white label platforms that companies use to create their portal, if you will, but there's not there's not the go-to WeFunder kind of stuff. Some places like Micro Ventures will offer up a variety of offerings where they'll have a Reg D 506C and a Reg CF and a Reg A Plus on their portal, right? So they have it that way. But for the most part, there's not like a place just to go, like Schwab and look them up or something like that. So
there's no consolidated list of Reg A offerings.
Right.
Maybe we should put one up on our website. I can work on that over the weekend. And
there you go.
There would be, you'll find it here on the coralcapital.com site here in about a week. So we're gonna
figure out how to do that. I'm sure there's an AI tool we can get to scrub those things. I'm giving up our secret sauce here. So, but I want to just say red flags to look for as we wrap out, and we'll go into this in more detail in a future episode, is that the way you look at and evaluate a public company, the kind of financial information that you have there, any industry reports, looking at, that it would be to me very similar to what you should be able to look for within a Reg A Plus. If I work with a client, we're going to create a deal room that gives people access to information that they need to make a really good, thoughtful decision about buying that stock. So it's not an emotional decision. It's not a lot of hype. There is going to be competitive analysis. There's going to be, your audited financials. There's going to be, a strategy of how that funding is going to look and stuff like that. And the other thing that if you should look at, if the company has raised capital in the past, how was their communications with those investors? Because it's really, really important to have a regular communication pipeline to your investors on your status. Transfer agents do that, which one of the things that Erik, one of his firms they do that, but there's also, quarterly updates and things that you're going to want to on a private basis, the same way a public company would do it with their shareholders. You're going to want to see that private company also communicates in a similar way.
shareholder communication is vastly undervalued. I can tell you that from my entire career. So many public companies, they're focused on getting new shareholders, and then once investors buy the stock, they neglect them, and that is a travesty. Shareholder communication is absolutely one of the most important things you can do to keep your shareholders happy and keep them motivated to own your stock. The price of stock is ultimately determined by supply and demand, and happy shareholders are not adding to the supply. I mean, I like to say that there's shareholders fall into one of three categories. Your first category is the guy who's looking to sell. The second category is the guy who just wants to hold the stock, and then the third category is the guy who wants to buy more. Proper shareholder communications is designed to shift everybody over. You want your sellers to become holders and your holders to become buyers, and you want your buyers to buy more. That's what creates momentum. When people have a momentum stock, and there was an article in the Wall Street Journal about momentum investing today, what they've ultimately done is they have convinced the guys who are going to sell it not to sell it, the guys who are holders, or enough of them to become buyers, and the guys that are actively buying to buy more. It's called momentum investing. But
Yep.
shareholder communications is vastly underrated, and more companies need to take it seriously.
Yeah, I think we talked about, I don't know, second or third episode, we got into part of the way public companies will reissue stock, and part of the success of those offerings is because they have good shareholder communication. So people want to buy more from the company.
Yeah, we had a bank client that did a rights offering, privately held. It was fully subscribed, because the
Yeah.
shareholders like the bank and like the management team.
Yeah.
So these are the things that people should consider and think about. Happy shareholders help you raise capital. Simple
Okay.
fact.
So we're doing hot topics next week, Eric. We can dig into Newsmax a little bit more and find some other ones that are looking good out there for talking about Reg A plus companies and how they did it and what's going on. Maybe we'll have
Yep.
your list.
We'll have our list. We'll have a list
We'll
of
at least have
regulations,
some
and where you can.
companies that we'll be able to talk about from doing the gathering for the list.
Yep. And there is and then companies conducting private placements and doing a general solicitation. Maybe we'll take a look at Old Glory Bank. If you're in the Atlanta area and listen to the radio, you may have heard the advertisement for Old Glory Bank's stock offering. I don't know if Karen has, because I don't think that station is on her list of pre-programmed. But
I don't really listen to radio much anymore. We'll leave it at that.
I only listen to some talk radio, but we'll leave it at that. But anyhow, look for us up on Spotify and Apple Podcasts now, and we will have content up on our YouTube channel shortly. And we hope to see everybody again next week.
Great. Onwards and upwards.
Onwards and upwards. We'll talk to you all later. Bye.